That kind of means that rates are probably going to stay pretty high for the foreseeable future, right?
That's crazy. Actually, I saw heading to that the rates haven't been this high in the last 22 years.
22 years, right?
That
So
is crazy.
it's crazy, right? And the reality is, where do they go?
Hi everyone, we're here today with George from Dominion Lending Edge Financial Services, and we're going to talk about what just happened this morning with the interest rates. Bank of Canada increased that to 5%.
Yeah, big news again, right? So we got another 0.25% increase effective today, and all the lenders will probably make their announcements of increasing the prime rate today, bringing prime rate to 7.2%. And it's crazy, yeah. I don't think I've ever seen it in all the years that I've been in the business, right? So it is definitely a pretty high rate. And the other part is that the announcement that the Bank of Canada made, right, is we're not going to see inflation drop to their target rate of 2% till 2025 now, right? Last meeting they were saying we're looking at 2024, probably in the second half. Now they're looking at beginning of 2025. So that kind of means that rates are probably going to stay pretty high for the foreseeable future, right?
That's crazy. Actually, I saw heading to that the rates haven't been this high in the last 22 years.
22 years, right?
That is crazy.
It's crazy, right? And the reality is, where do they go, right? The Bank of Canada has kind of left it open for the possibility of a future rate increase. So obviously they're going to monitor real estate activity. They're going to monitor GDP, which is still on fire. Employment still kind of creating some good jobs, right?
Yeah,
so
that's what I'm saying.
People are spending money, right? So people
Where's
need
that
to
money
stop
coming
spending.
from?
Well, people are there's good jobs out there, so there is good disposable cash available to people. People did have money, during the pandemic, and they're slowly spending it. It's just like you said, where does it stop?
Do you think they held the rates down for too long back in 2021?
Yeah,
I think
absolutely.
they should have increased it back in October, November of it when they said, okay, Delta came and let's just not increase the rates. I think that's when they should have gone up by 0.25.
Yeah, I totally agree with you, right? Because in 2021, in the fall of 2021, the Bank of Canada came out and said, we're not increasing rates until 2023, right? So then obviously a lot of people went into the variable rate mortgages at that time because it was so cheap, right? And then obviously 22 rolls around and we know what happened. You get a 4.5% increase over that
short period of time.
Where it just
became
like
3 months.
Well, it was like, really, if you think about eight announcements, right? But in a short period of time, right, we had these rates, especially for variable rates, go up significantly, right? So then what we were seeing is we saw the bond market kind of reacting to that as well, just saying, okay, well, if prime rate's going to go up, then we have inflationary issues. So the bond yields continue to rise. And, they're still a little bit lower than prime rate, but you know what? They're catching up pretty quick.
So let's right now talk about it. So the prime rate went up. The variable rates are going up with it as of tomorrow.
Correct.
With most banks, and fixed rates. What's going on with that?
So fixed rates are, they're pretty high. We're seeing the 1 and 2 year rates over 6%, like the 1 year rates are like anywhere between like 6.39 up to 6.99 on a 1 year rate, right? 2 years are a little bit lower. And then once you get into the 3, 4, and 5 years, so the 3 and 4 year rates we're still seeing in the 6% range. 5 years, 4 and 5 are kind of hovering just a little bit below 6%. So
and do they give any discounts or no? Is there any discounts from the banks?
Not on the fixed rates, really, right? Unless there's a buy down or some lenders.
About a month and a half ago, before the last rate hike, I remember. I think it was TD offering 2 year for 4.79.
3 years. 3 year terms at 4.79.
That's gone.
And now we're closer to 6% on that 3 year. So the bond yields have gone straight up. Funny enough, today I kind of thought this was going to happen, right? So the bond yields right now have kind of pulled back a little bit today, but not by a crazy amount. So probably some profit taking on the bond market, but we'll probably see it pull back a little bit. May not be enough for lenders to start dropping the rates yet, unless there's a trend where they see the 5 year bonds starting to drop. Then the lenders may adjust their rates. But I think right now the rates are going to just bounce around in a tight little range until we see what really happens. We got the next meeting from the Bank of Canada in September. So, for the summertime, things will kind of cool off a little bit, probably just stabilize a little bit. But the question is, what happens? So we'll see how the economy performs over the next couple months, see what the real estate market does, and that'll impact what the Bank of Canada does.
So 2 things I want to ask you. One, what do you think is going to happen for the rest of the year with the rates? And 2, do you think now that the rates are high, banks will start offering more discounts in the last quarter of the year.
Yeah, so going back to your first question about the rates, I believe that the fixed rates will come down a little bit and then just kind of float in a very tight range till the end of the year, right? Unless obviously something significant happens on the global stage, right? Which we don't know. Now going to the variable rates, some of the discounts may happen, like they may start increasing them a little bit to make it a little bit more attractive for people to get into a variable rate mortgage, right? So at the end of the day, it's up to the individual's risk tolerance and what they think, variable rate's going to do versus the fixed rate.
Right.
And you make a decision based on what you want to do today, and you ride it out.
Right. Let's also talk about the adjustable.
Yeah, so there are some people that are an adjustable rate mortgage, adjustable rate variable rate mortgages. So that way, what happens there is your payment may not change at the time a Bank of Canada makes an announcement, but eventually what will happen is you will get what they call a trigger rate, and then you get a phone call from your lender saying, Mr. and Mrs. Borer, it's time to increase your payment because you're no longer covering the cost of interest. So I had that yesterday. A client actually hit his second trigger rate, which obviously doesn't make them that happy. But those people, again, you have to have that conversation to see, can you afford this, right? Problem is, though, even to try and get them into a fixed rate, the payment doesn't change that much. The only thing is that you've locked them in for a payment. So if there are future increases, they won't be impacted, right? But again, it's on a case-by-case basis. You have to understand what your finances are looking like, and we'll make some judgment calls. But if you're going to go from a variable rate into a fixed rate, you've got to be mindful of penalties if there are going to be subject to penalties, and then see, does that carrying cost still make sense for you? So case-by-case.
Let's talk about some of the solutions. What are the solutions for some people that have their payments increased drastically? So let's just say the normal variable mortgages that are going up. What's their option, and what's the option for these adjustable variable rates? Because once you hit the trigger rate, how do they adjust it? Like, how much does it go up? And is there options or negotiations that they can do with the banks?
So I have found so far over the last year, most people have been able to adapt to the rate hikes, right? Because at the end of the day, we were qualifying people at the stress test rate to begin with, right? We're probably a little bit higher than where we were, a year or 2 years ago when we were putting them into the variable. Not everyone put that money aside or had that buffer. So some people said, hey, I got an extra $500-600 a month, and they were spending it. But I've had people say, okay, you know what, we're going to reallocate money from our savings plan and ride it out and stay with our mortgage, right? I've had some people lock in, right, into shorter terms, pay the penalty because they said, I can't handle any more changes. And, in the worst case scenario, and I've had one client, unfortunately, they sold their property, just like, can't do this, right? So wide variety of solutions out there. The banks, are trying to work with people because the banks don't want to own homes, right? So they are looking to extend amortizations to make it work.
But you have to get requalified to extend amortization.
No, they're not really requalifying people. They're just kind of working with them. It's not the ideal scenario because all of a sudden you have like a 40 or 50-year amortization on your mortgage, right?
Oh, so they increase it up to that much?
Yeah, they're extending at least up to 40. Like they're doing it to at least help people, right? Again, you have to qualify for that extension, not from your income and all of that. They just look at it and say, okay, what financial resources do you have available?
Got it. You got like your income and situation.
Your income. And if you got assets, well, start using your assets. You know what I mean? So there are some options. Fortunately, I haven't had too many of those. It's really just been about, all right, we're adjusting our lifestyle accordingly, or we're locking into a fixed rate.
Amazing.
Yeah.
George, well, thank you for coming on. Thank you. If
it.
anyone has any questions, we're going to put George's contact info down below, his IG address as well. And thank you for watching, and we'll see you next time.
Thank you.